And I'm just gonna start so that this will be recorded and I'll send out to everybody. But just so everybody knows, John Belenfant is the owner of Belenfant, which is the company that we use for our finances. You either work with Sydney or you work with Keegan, and so John oversees all of the process, and he's extremely involved in speaking with Liz, myself, Stephanie, and the leadership team. So I reached out to John to see if he could kind of give all of us an overview of finances. I think this is something that I am very excited about, just to have a overview. So if you guys have any questions, please feel free to leave them at the end for John. But John, I'll let you take it away.
All right, great. Yeah, it's a pleasure to be with you all. Don't get too excited. We're just going to talk about, finance for nonprofit organizations. I mean, what you guys could picture your perfect morning coming back from a long weekend, just talking to your company's accountant. I mean, how exciting.
It's very exciting.
Kayla scheduled this. This wasn't me. So let me just pull up. As accountants do, I made a spread PowerPoint. One second. Pull this up. Okay. All right. Can you all see that? Are we in good shape?
Yes.
Cool. All right. Looks a little cut off, but we'll roll with it. But yeah, so anyways, my name is John Belenfant. It's a pleasure to be with you all. Yeah, as Kayla mentioned, we are the accounting firm for Affinity Strategies and all your lovely clients. Hopefully you like our team because you see a lot of us probably. We work out of Nashville, Tennessee. So we're a little bit further from a lot of you all who are kind of in the Illinois area, but I know some of you are spread out and whatnot. But Kayla just kind of asked me to, she gave me this lovely title here, From Balance Sheet to Budget, Nonprofit Finance Made Simple. So I'm just going to go over just super high level, just like basic finance, basic read the financials. I'll give you a little background on our firm and then just tell you where you can kind of reference some good resources. But yeah, if you guys have any questions or concerns, like please stop me as I'm going. I don't think anybody wants to listen to me talk for 60 straight minutes, and maybe we won't take the whole time, but make it conversational, right? Like this is for you guys. Like Kayla wanted this to be beneficial for y'all. So you won't ask any dumb questions or anything like that. If anything, now's the time to ask what you might think is a dumb question. We can kind of get out in front of that and educate you a little further. Also, if this spurs questions or thoughts or whatever on like organizations you're working on, like you can bring those to us as well and just say, hey, you brought this up, like, are we doing this? Are we doing that? So on and so forth. But yeah, I just made a quick agenda here. I'll just go over a little bit of our background just so you know more about us. And then we'll get into the fun stuff, nonprofit finance. And then, like I said, I just have a list of resources at the ends, and then I'll open it up for questions at the end. But I'd rather it be conversational questions throughout. But if you do want to save some questions for the end, that's fine too. Here's some pictures of our firm. I won't bore you too much about this, but this is something that we just like to present on PowerPoints that kind of just shows our culture. We're very much a team. We like to do things together as a team, as you can see. It's a very hardworking industry. It's a lovely public accounting industry. So we try and go and also play hard alongside working hard. So there's a number of our team events from the past like year or two. Here's some boring things about me. Nothing really too exciting here. I went to University of Tennessee. Fantastic. I'm a member of a bunch of associations. And yeah, I've presented on similar topics to similar organizations. One thing that we do highlight about our firm is that we made the Inc. 5000 list last year. So Inc. does a 5,000 fastest growing private companies list annually. So we made the 2024 list. We're hoping to also make the 25 list. But yeah, it made us the fastest growing CPA firm in Tennessee. So that's pretty cool. And we're just a team of 20. So we're still pretty small. But go ahead. Just one other question. Okay. But yeah, we're still pretty small, but we are growing, as you can see, pretty quickly. So that's wonderful. Any excuse for us to pop a bottle of champagne, we'll usually take that. Okay, cool. Let's talk about boring things. Financial statements. So, you know, I just have super basic slides here, and then I was gonna just open an example and kind of go through it with you all. But these are the nonprofit terms of financial statements, right? So statement of financial position, a lot of people know that as a balance sheet, but the actual nonprofit term is statement of financial position. So, you know, it's assets, liabilities, and net assets. That's also similar to a for-profit balance sheet, except net assets would be called equity. But yeah, you know, under assets, you've got current assets and fixed assets, other assets. And then under liabilities, current liabilities, long-term liabilities, other liabilities. You know, what makes something current is that generally, like under assets, it's liquid. So like cash or an investment, something that you are, or an accounts receivable, something that you're going to receive in the next 12 months. So it's generally something like within the year. Or it's a liquid asset. Current liabilities would be something that you're going to pay in the next 12 months, right? So an accounts payable, a credit card balance, or some kind of unearned revenue. And then a long-term liability would be something that you're going to pay after 12 months. So if you've got a 5-year note, or debt or whatever it might be, anything that's not getting paid in the first year would then go to the long-term category. Under fixed assets, that would be anything like furniture, equipment, building, property, things of that nature. And then under net assets, you've got with and without donor restrictions. So those are the two classifications, but under without donor restrictions, boards also have the ability to designate net assets. It's not super common. It used to be more common for whatever reason, people kind of moved away from it. But if boards want to like put money aside for whatever kind of like reserve or something like that, and they just want to like not create a separate bank account or not create like an endowment or something kind of like more serious, they just want to be like, hey, you know, we want to have I'm trying to think of a good example. Most of them, you know, we want to be able to put aside $20,000 for next year's fall seminar. They can kind of like designate certain funds. So they can have actually designations within that without donor restrictions category. The next financial statement is statement of activities. So this details the revenues and summarizes the expenses into those three categories under, they both say revenue. We just made this PowerPoint this morning, so bear with me. I'll send this out with a revised version, but that second one should say expenses. But yeah, it goes over revenues and expenses. I think it's pretty straightforward. I don't think there's anything really I want to touch on there. Then, you know, if you're looking at an issued financial statement, so like an audit, a review, a compilation, something that a CPA firm is signing off on, that's not just like internal monthly financials. There'll often be a statement of functional expenses, because on the statement of activities, it's summarized into these three categories. And then on the statement of functional expenses, it more so aligns with your budget and has like a line for, you know, actual expense items rather than just these 3 line items. But yeah, expenses are broken out to these 3. So program services is everything that aligns with the mission and the vision of the organization. Management in general is a lot of like what you guys do on a daily basis for these organizations, kind of executive director role, things that we do, right? Accounting, that would be like management in general. And then fundraising would be anything spent towards raising funds for the organization. And then the last financial statement generally presented as a statement of cash flows broken into 3 categories. We don't have to go over that too much. Let me see if I can pull up my example. Any questions so far on just generally financial statements or anything I've said? Kind of blew through that pretty quick. Okay. All right, I just dragged an audit report into the screen. Did that work? Can you guys see this audit report, or does it still have my slideshow on it?
It's still on the slideshow. Statements of cash flows.
All right.
I know Zoom is weird where you have to reshare.
Yeah. Okay, how about now? Is it working now?
Yes.
Cool. This is the Alzheimer's Association. I just pulled like the largest association I could find in Chicago. This is an audit report issued by Grant Thornton. They're like a top 5, maybe 6 CPA firms. So they're gigantic as well as this organization is. So I was just going to go through just some things for you guys to look out for when you're evaluating these financial statements, add a little bit of color rather than just like a PowerPoint. So like I said, this is a large organization, so you can see these numbers are in thousands, right? So if you look at cash here, you see 24 versus 23. 46,000 means 46 million. Or 304,000 investments, 304 million. But yeah, so what if just to add color, I think one of the best things I look at is total expenses, right? Like, because that kind of aligns with like budgetary kind of understanding of, hey, we budgeted, we were going to spend, 450,000. I'll just say it for that purposes for this. But if you look here at total expenses, we spent 475,000. So we're 25,000 over budget, but I like to compare total expenses to, kind of the liquid assets on hand. So, if you look at cash of 46 plus investments of 304, so they've got about 350,000 of liquidity, compared to 475,000 of expenses. So I think that's a really decent measure. I think the affinity clients usually have at least that, if not like multiple times their total budget. So, in years where organizations have not great bottom lines, like they might have a deficiency like this does, it's always good to kind of point them back to the balance sheet. Say, hey, well, yeah, we lost $10,000 and we didn't really come out ahead with a positive change in net assets. However, we still have a gigantic reserve. And the goal is to have a positive change in net assets and have revenues exceed expenses and sunshine and rainbows every single year, but it's just not the case in nonprofits. A lot of nonprofits are very, very much in the term nonprofit. Others are, doing really well and have a consistent stream of revenue that exceeds their expenses. So make sure you're not just, I think it's probably pretty easy just to look at the statement of activities here, right? And look at revenues and say, revenues was 465 and expenses was 475. We lost 10,000. And then what they do on this report is they put other changes in net assets underneath this. So they actually, their investments did really well. So it actually brought their $10,000 deficiency from operations, is what they call it, to a positive 12,000 change in net assets. Once again, it's 12 million, but, so, once again, what this does is, when you have a positive change in net assets, that's just, revenues exceeding expenses. It's taking that net asset balance from the prior year and increasing it by that bottom line. So net assets is once again, everything that where your assets exceed your liabilities, then you're left over with net assets. So that's the goal every year, is to have a positive bottom line, continue to add to the net asset balance and watch it grow. I'm not sure. Was someone asking a question? I'll stop there in case anybody was asking a question.
Hey, John, it's Stephanie. I have a quick question. When you talk about investment gains, can you just touch on realized and unrealized?
Sure. So yeah, and oftentimes they make it in the same line item like this one, right?
Yeah.
Realized are if you bought Apple stock at $100, and then in the fiscal year that these financials are showing, you sold it for 150 and you made $50. That'd be a realized $50 gain. If you did not sell it, it'd be an unrealized $50 gain. That's the only difference. So in accounting for nonprofits, you recognize both of them, but you know, if you're doing somebody's tax return or whatnot, obviously if like they didn't sell the Apple stock, there's no taxable gain. You don't tax unrealized gains. But for financial purposes, for nonprofits, that's absolutely something that you recognize, because basically you mark this investment account as of the end of the year to its fair market value. Does that answer your question, Stephanie?
Yeah, I knew what the difference was, but I sometimes struggle explaining it to the clients,
Yeah,
because they look at it as money they have in their hand, and it's typically 3 months late and, you know, not real money.
Hmm.
But I just, I understand what it is. I just think when we talk to our boards who aren't financially savvy, um, it's good to, I mean, I can't think of too many occasions. Most just let it sit and it's almost always unrealized, right? Um,
Sure.
most, right? But, that number's only as good as the market the day the investment report was put into the statements, right?
That's
That's,
right, Stephanie. That's a really good point. Yeah, that's as of, June 30, 2024, right? And that's, that's why it has the date at the top and specific to that. But yeah, there could be, you could be looking at this, today, May 27th, almost a year later, this could be a completely different number. But the good news is if it was that specific day or it was within a month, or hey, maybe it's higher, it should be higher, right? Every year the market goes up on average 10%. um, they technically could sell all of these assets, because generally speaking, it's some kind of equity and bond portfolio with a financial advisor. So they could liquidate this whole investment balance and then they have it in cash. So they could generally do that, because it's not going to generate any kind of like large taxable gain. These are nonprofit organizations. So selling stocks for like a large gain or something, like an organization like this, Alzheimer's Association, who knows what their basis is in this 304, like how much they actually invested to get to the 304. But if they invested 100,000, they have $204,000 of gain. It doesn't matter because it's a nonprofit. So they could just liquidate that entire investment portfolio and have it in cash. They don't have to worry about a tax liability or unrelated business income or anything like that.
thanks.
Of course. Okay, so I'll keep going if we feel good about, what the general bottom line is there. This is comparative. Here's the statement of functional expenses. So just to quickly touch on this, that comes after that statement of activities. So once again, the statement of activities, if you look at the expenses, it just says like program services and supporting services, which has the fundraising and management in general. this doesn't add a lot of context to it, but oftentimes the statement of functional expenses could be like, 5 or 10 or 15 more lines than this and just kind of go into detail on that. But for the Alzheimer's Association, they don't have a management company. They have a lot of salary. So they pay, all their people, there's their amounts. And then it's broken out in a columnar format for each one of those program services. So like these are their large program services for their organization. And then over here under supporting services, you see fundraising and management in general. So these line items more align with like what they would budget for internally. Final financial statement here, statement of cash flows. So it's a little bit of a probably intimidating looking financial statement if you're not used to looking at these, but all it does is reconciles that bottom line, which was positive 12,000 for 24. Looks like they lost money in 23, negative 26,000. Down to a net change in cash. And so their change in cash for 24 was almost identical, 12,366, 12,738. Whereas last year, you can see they only had a change in cash of negative $767, even though their bottom line was negative 26,000. Well, there's a lot more factors that go into it, right? And all those factors are explained between the change in net assets and the change in cash. But all those should be explained there. I'll stop there too and just see if there's any questions on just like this example, or if anybody has any questions of other things that are good to look out for or anything like that. Okay. Then let's keep rolling. Okay. So I'll go into it in a quick slide on assurance. So this is a word for audited financial statements, reviewed financial statements, compiled financial statements. It's called an assurance service line from a CPA firm. So I just threw some Illinois numbers on the bottom there too. These are new numbers as of the last year. So if your organization has 500,000 of revenue, and it's mostly contributions, or sponsorships or things of that nature that would hit that $500,000 threshold, then you need an audit. $300,000 threshold needs a review. And I just threw a compilation on there just because that's actually like the third service line in this category. So it's just something to be aware of. But obviously, an audit is a lot more involved than a review. It's a lot more costly. We have a lot more professional standards as an audit firm in order to come in and do that. But just a heads up, we can't do the audit anymore, whereas we used to be the audit firm for Finney Strategies, because now we're the internal accounting firm. So there's got to be an independence between internal accounting firm and external accounting firm. So external accounting firm is the one doing the assurance, doing the audit, doing the review compilation, because they're basically coming in and auditing the financial statements that we prepared. So we can't audit ourselves essentially. So just drawing that comparison there. But part of our engagement too with Affinity is that we will handle a lot of this. So you guys shouldn't really be incredibly involved. You might have to handle like, some questions here or there from the audit firm, but most of it will kind of be up at like our level, or it might even go to like Kayla or Liz or Stephanie or somebody else. Cool. And then to touch on 990s really quick too, like, here, there's 3 different forms of 990s that you generally see. So, if it's a really small organization, like maybe an association spun off like a small foundation, and they don't even raise like $50,000, you can do what's called a 990N, and it's an incredibly quick and easy, just like one page. You said there's less than $50,000 and you file it, and that's it. Then as organizations grow, it says normally revenue 200,000 or less. So like if there's a one-off year, you're not supposed to go from category to category. You're supposed to stay in whatever's kind of the general understanding of how that organization does from a revenue perspective. So normally the revenue is 200,000, or they have less than $500,000 in assets. You can file a 990 EZ. It's a short form 990, so it's just a lot quicker, a lot easier, not as much detail involved, so on and so forth. And then for the vast majority of the affinity clients, we file the long form 990 because revenues are over 200,000 and or assets are over 500,000. But 990 is incredibly important for an organization. It's the annual information return between the organization and the IRS that gave them the charitable status. If you don't file your 990, you can lose your charitable status. So yeah, we're going to make sure all these are filed and filed timely as well. They also don't mess around with filing these late. The late filing penalty is pretty nasty. It's a daily penalty for not filing them on time. So nothing y'all need to worry about. We got this part handled, but just something for you all to be aware of. If clients are ever asking about them or anything like that, just know that, they're being taken care of. Any questions on audits or 990s from these two slides?
How long does the audit process the audit and review process normally take?
How long do they take? Great question. It depends on the audit firm a lot of the time.
Okay.
We should have our current audit firm seems to be moving a little bit slow. But we did engage them a little bit later than we would have liked to. So since the ball got rolled a little late, they started a little late and so on and so forth. So, but if all information's in good shape, in good fashion, 6 to 8 weeks is probably like an audit timeline, whereas reviews more like 4 to 6. A 990, we generally do after an audit is completed. And then if there's not a financial statement needed, we generally just go right into the 990. So with completed financials within 4 weeks for sure, 2 to 4.
And is there like a certain period of time throughout the year, like where we should expect those audits to happen? Like, is it every April, every May where you normally do the audit? What is the time frame?
So there's a lot of different year ends with your clients. If I remember correctly, Kayla, I think there's like some June 30s, there's a few September 30s, there's some December 31st. We're trying to close year-end financials within like a month or two. So the audit firm should be like ready to go by, the 3rd month after the year end. So based on their year end, I would think that within 90 days, they're starting their engagement. And then the 990s do, the 15th day of the 5th month after. So if it's a December 31st year end, the 990s do May 15th. In a perfect world, they complete the audit and then we do the 990 on time. But you can extend the 990 for 6 months and file it by the 15th day of the 11th month after the year end. And if that's not a big deal or there's no pushback from the client, audit firms do appreciate having a little bit of leniency just to get it done as they can get to it, so on and so forth. But then the 990 is really just kind of wrapping it up at the end of the year. Also, for those that are required to file with Illinois, whether it be an audit or review, or they're just a 501c3, we do have to file an Illinois 990 as well. Just in case you guys were wondering about that. What else we got?
John, I have a question or an experience that I want to discuss or explain. So a lot of us are C6s. So we have potentially lobbying expenses. And I've been caught before with my organization of, not putting the right dues amount in, a dues statement, and then not being, having to, what happened was we didn't file an extension for a report that needed to be added to the 990, and extended along with the 990 because of lobbying expenses. How can we avoid ever having that problem again is really my question, because it may apply to some people, maybe not, but are there other extensions or other filings with the 990 that we should be aware of, I guess is my question.
It's a fantastic question. Yeah, so lobbying is, I mean, you want to talk about what a 501c6 organization does, right? I mean, it advocates on behalf of that industry. And so how do they advocate on behalf of that industry? Well, a big part of it is going to the courthouse and saying, hey, this is what we want. So lobbying is a huge deal for C6s, and basically the part of the 990 that you report that on is called Schedule C. And it's required to be completed for every C6. So yes, we would have that done every single time. And for the record, we work with roughly 100 C6 organizations. So we will not leave your C6 in the dust on this. But membership dues to lobbying is a specific ratio that you're supposed to track as an organization on an annual basis. And on your dues invoices, you're supposed to say what % is not deductible because it's being spent on lobbying activities. So let's say, for instance, for simplistic purposes, there's $100,000 of dues revenue. Okay, and then let's say they spent $20,000 on lobbying activities. Well, your dues invoice for the next year should say, hey, 20% of your membership dues that you're paying to our organization is not deductible for income tax purposes. So it's usually in little tiny script at the bottom of the invoice that nobody reads, but as part of your C6, it is a requirement that you do that. So that might be something for each one of y'all to kind of check in on and just say, hey, have we checked in on our lobbying expenses? Are we good? Are we meeting the threshold? So on and so forth. Because let's say you put in 20%, but the next year you spend that same $20,000 on lobbying, but dues went down. Dues went down to 95,000. Well, all of a sudden you communicated a lower amount. Well, what you're allowed to do, Amanda, is you're allowed to catch it up. So you can kind of carry forward that overage or that underage. And so it can kind of help you even it out as you go forward. But what the IRS wants to see is that you're just like not consistently underestimating it. So if you're just like continuing to add to a deficit, add to a deficit, add to a deficit, they don't want to see that. And then they can potentially charge you some kind of like penalty for it. But no, essentially, if we saw that it was lower than the amount, we would want that to be communicated to you. And then some organizations just don't have a ton of lobbying expenses. So it does depend on the organization, right? So if they're a C6, but they're not really even doing any lobbying, then like you basically check the box on the Schedule C, like, hey, this organization is basically doing no lobbying. So we don't even really have to fill out any numbers here. But yeah, that should be a number that's visited. So then I'll touch on the other side of that too, Amanda. So like if it's a 20% communicated in dues invoices, they spent the 20,000, but then dues went up to 120. They're like well under it, right? So then we wouldn't say like, hey, you need to increase this or anything like that. It'd be like, you're good to go, because you'd rather be on that side of it than under it, because that's probably what happened in your scenario. And then, yeah, maybe it happened numerous years in a row. Then the IRS caught on and they're like, hey, and this is a huge part of the 990, right? What you're communicating with the 990 from your organization to the IRS is, hey, we're operating within our mission. We're operating within our vision that we told you we're going to when you gave us our charitable status. We have a legitimate board of directors. We're issuing 1099s to independent contractors as needed. None of yours will issue W-2s, but that would be like you're complying with all the tax code. Even though it's a nonprofit organization, there's still a huge chunk of compliance that these nonprofits have to have with the IRS. So this is one of the biggest parts of for C6 though.
Thanks, John. I have another follow-up of things that confuse me about filing 990s. And I'm newer to Affinity, so I'm newer to working with y'all. So I've worked with several nonprofit accounting firms that frankly have let us down in certain ways. So these are why I have these questions.
Great.
But another one that we talk about a lot is UBIT, so unrelated business tax. And it's always been fairly confusing to me as a nonprofit about what is and what isn't, because I know it has to be in line with your mission, but is selling t-shirts in line with my mission? It might be. I mean, I'm always like confused. Like, could you provide any sort of example of like things you've seen that's definitely, you know, an unrelated business tax situation and things that could be but aren't?
Yeah, it's a great question. So unrelated business income, yeah, you nailed it on the head. Anything that's not related to your mission or vision. So selling t-shirts generally isn't. But the biggest one we see is typically advertising. So your C6 issues a newsletter or a magazine that you guys sell advertising in it. That would be unrelated business income, because I guarantee you that your C6 mission and vision is not producing advertising income. So that's the mindset you would want to be in if you're evaluating revenue streams. So what you're allowed to do when you identify that advertising revenue is you're allowed to then, you split off advertising revenue, let's say it's $20,000, then you can identify expenses that were spent to produce that income. More likely than not, you're going to find enough to offset it. Another one would be, we have a C6 Independent Insurance Agents of Tennessee. So it's all the independent insurance agencies in Tennessee. And basically we're based out of Nashville, by the way. Yeah, I said that already. They have a P&C insurance agency, just like that they own. So yeah, any revenue from like actually being their own independent insurance agency, that's unrelated business income, because what they are as a C6 is they advocate on behalf of independent insurance agencies themselves. They don't actually do insurance, but since they do, that's unrelated business income. Another one we see is that the organization owns their own building, and they have debt on it, but they lease it to tenants. So they went out, they bought a building, they got a mortgage on it, and then they were like leasing part of it to other tenants. Those are the main three that we see for C6s. But yeah, if it's unrelated business income, we just want to identify as many expenses as we can to offset the income. So there's because if there's a net income, then you pay income tax on that. But the IRS doesn't see that as a problem. They would more so be concerned if you weren't identifying the unrelated business income itself. But once we do identify it, there's generally enough expenses to offset it. And if there's not, you pay a little bit of income tax and you move on. It's no big deal. It doesn't jeopardize your charitable status or anything like that. But if y'all have questions on that specifically, please raise concern and raise questions on that. We'll be happy to, because we want to make sure that everything's reported correctly, and that's definitely something we want to make sure of. Those are great questions. Okay. Here's 3 really good resources. GuideStar holds all the 990s. I need to change the title on that, but it holds all the 990s. So if you go to GuideStar, I can share my screen. You can just come here and you can punch in any organization and search. You can just create a free account if you don't have one. And you can find 990s and profiles of like all nonprofits. So that's a great one to use and just see how other folks are handling things or how they show stuff, how they recognize things on their 990s or anything like that. Another one you can use is ASAE. So I'm sure you all know who that is, but just in case you don't, they have a lot of continuing ed too. I think that's shared. So if you go to resources, like you can come to topics and go to finance, or, you know, if you want to see what they have on technology or membership or meetings and events, which you all are specialists at, but, you know, I think ASAE is a wonderful thing. And then the AMC Institute as well will be the last one that, you know, we even reference as a CPA firm sometimes. But this is, you know, a nonprofit, just like you guys are used to managing, that holds membership for AMCs all over the US. So they have an accreditation that you can get. But, you know, they come in order to be AMC accredited, they have to come in and review a number of the ways that you're managing your associations, make sure you're doing it the right way, meeting all their criteria. But they do have some good education pieces as well. So the one thing I didn't touch super closely on was the budget itself. You know, from a budget standpoint, I have a very boring slide that we can look at for budgeting, but you know, if I'm looking at budgeting, the tips would just be, you know, I don't know how many people know this, but you can revise your budget throughout the year. So like, let's say, COVID-19 happens, right? It's like, whoa, what are we gonna do now? We can't have our events, like, you know, that's a huge revenue stream of ours. We usually net all of our net income for the year. We break even on everything other than our events. So like, what are we gonna do? Did we have like event cancellation insurance, like whatever, you know? So that would be a time where on your next board meeting, I would consider bringing up like a revised budget or an amended budget, whatever you guys call it. And just be like, hey, you know, we budgeted $200,000 for this event, but it's not going to happen. That's a very like wild scenario, obviously. Pray to God that we don't have to go through another COVID-19 scenario, but that's just an example as to like revising a budget might make you just look better too, because it's like, well, we weren't foreseeing these certain circumstances that came up during the year. So we really feel like we need to revise the budget to make it a little bit more aligned with what actually is going to be expected for the year, which kind of goes into the second point, you know, make your budget realistic. You know, although it's great to shoot for the stars, if you shoot for the stars and you don't make it all the way up to the stars, then you're explaining to your board that, hey, you know, we budgeted a $200,000 bottom line and we broke even, and they're sitting there like, well, why did we budget $200,000? You know, some plan for the unexpected. It's good to just have like a contingency, almost like an other expense line item that has some expenses drawn in there. Just in case, you know, you have several overages in your expense categories, you have like another one just kind of sitting there, contingency is what I like to call it, that you can pull from. And then all of a sudden, you know, hey, we actually did come in under budget because we had this nice other. The other thing would just be support and sustain growth. I don't, you know, you always want to, you have to shoot for the stars per se, like I said, but you know, if you're coming in and have a realistic expectation on bottom line, you know, they don't want you to say, hey, we think we're going to break even. And it's like, well, you know, you guys as an association management company should know how we should be able to get there to have at least some kind of positive change in net assets. Like I said, it's not expected every single year, but, you know, people on boards are obviously going to want to see, you know, their net asset balance increase year over year, at least over the years. If there's a slight dip in a year, they want to see you come back and rebound and continue the trajectory over years. But yeah, that's basically all I've got. Hey, we made it to 10:46. That's not too bad. If you guys have any questions or concerns, please reach out. I kind of blew through that, and it's a very basic presentation, I would say. So, if you want to get granular or have a separate discussion with us or our team ever, and just say, hey, I was looking at our financials and I'm kind of seeing like these metrics, or if you just want advice on just like what to bring to your board to make your case or make you look good or whatever it needs to be, let us know. We're happy to have those conversations. And just use us as a resource. We're here for you guys. So I'll leave it at that and just see if you guys have any more questions.
I have a quick question, John. I cannot remember where I heard this from, but can you briefly talk about having an invoice that is unpaid and it being bad debt for the society and that being a negative, or that having a negative impact on the society? Is that a thing, or did I just kind of hear two things and connect it? Can you kind of briefly talk about that?
Yeah, absolutely. As long as you say you didn't hear from ChatGPT, then I'll answer the question. No, I'm kidding. But let's say that you bill a member for sponsorship or membership dues, whatever it might be, right? $1,000 bill. If they just don't pay it, well, at the time, if it's billed, it's kind of expected to be received, right? Why else would it be billed? So for accrual basis accounting, if the service has already been provided, it's recognized as revenue when billed. So it's a receivable because they haven't received the money, and it's revenue if the service has already been performed. So if that member decides to not pay it, well, then you've recognized revenue that you never are going to receive. So essentially, you write it off to decrease the accounts receivable and decrease the revenue. And you can what's called a bad debt expense. So you recognize an expense, which then reduces the revenue. So then all of a sudden you gained nothing from that $1,000 invoice because it was never paid. $1,000 revenue, $1,000 bad debt expense gets you to a net zero. Does that explain it, or do you have further questions from that?
No, that kind of makes sense.
Okay.
But when it's filed, does it negatively impact the society in any way? Like if we show all this bad debt to, I don't know, like on a 990 or to the IRS, do they look at, it doesn't hurt the organization or anything, does it?
No, absolutely not. And honestly, membership is discretionary, right?
Yeah.
So, what we do oftentimes, since membership dues is billed in advance, like let's say you're billing membership, let's say you're a June 30, and you're billing for the upcoming membership year now in May before next year even starts. People just don't pay it, then we just don't even recognize the revenue.
What about for a sponsorship? Say it was like a $5,000 sponsorship. We billed them, they did or did not come to the conference, and here it is like a year later, and we're still showing that on our AR report. Like, what would, do we just write it off as bad debt?
Probably.
Okay.
Probably, but no, they don't care if there's bad debt expense or if it's just a decrease. If you just decrease the revenue, then you don't have to show bad debt expense. But if there was like a large line item for bad debt expense, the IRS is not concerned about that. Neither is your audit firm.
Okay. I don't know where I heard it, but I just heard that it could have an impact on the organization. But thanks for clearing that up for me.
Absolutely.
I had a quick question too. So for my client AS&M, we just recently created a few scholarships and awards that go towards, like traveling to the meetings and stuff. And I had a few speakers at the meeting who were like, take my honorarium and donate it to this scholarship. What should I process to like how should that process go to you guys to inform you that the $1,200 honorarium, that's not, ASNM doesn't pay $1,200 for honorarium, but I'm just using that number as a an example. But like let's just say somebody got a $1,200 honorarium. How would I go about doing that? Like, do I need to send something over to Keegan to let him know like that honorarium is now being turned into a donation?
So basically, if there's an honorarium of $1,200, and let's say it is paid to the individual, they get a 1099 for the honorarium, right? So there's a couple reasons that they probably don't want that. One is probably because they're like, I don't need $1,200 and I'd rather it go to the organization. The other one is they don't want 1099. So if the money never goes to them, then you don't have to issue 1099, which is great. But if the money just kind of stays with the organization, there's not a whole lot to transact on, right? Because the money just stayed with the organization. So essentially, we need to know when the $1,200 honorariums are going to the individuals so we can process them, but then also make sure 1099 is issued to them at the end of the year. But if it's staying with the organization, it doesn't really, you can't really just like move it from one account. I mean, you could, I guess, move it from one account to the other, but it's not necessarily a contribution unless that individual takes the money and then contributes it back.
Oh, okay.
Yeah. It's a little finicky, but happens a lot.
So I actually have a question on top of that because that happens all the time with me as well as my clients as well. Especially Sown, like they'll get like, let's say a lectureship award and they're like, yeah, we just want to donate it to the ENTNF. In that case, they want credit for the donation. So in that case, they would still get it's not enough to produce a 1099. It's under $600, but they want credit. So they want it to be like, they want to see, deduct it from Sown, add it to ENTNF, put it in whether the lectureship or, I mean, they're usually saying exactly where they want it to donate. So is it just because, I mean, can they do a journal entry like in Kayla's case or in my case, I think I've seen it done.
Yeah, I mean, different organization, yeah, they can do that. But I don't know why they wouldn't want the money to then just turn around and make it. But yeah, the money could be sent from one organization to the other. Absolutely.
Because it's just like they want to see like this bucket go bigger versus, and like, because yes, it's all Sown's money. Well, in this case, it's all Sown's money. ENTNF actually has separate accounting, but sometimes they do want to like see it as, hey, if I made a donation to this scholarship fund or this lectureship fund, I want to see this fund go up, even though technically it's all the same money, but they like to see it that way.
Yeah, but whenever that happens, whoever kind of the accountant is on your account, just reach out to them and say, hey, this is what these folks want to do. And then we'll absolutely make that adjustment, no problem.
Okay.
Anyone else questions before we let John go? Hearing none. If anybody else does have questions that come up, please feel free to send those over to myself or John, and we can kind of sift through those, and then I'll send this recording out to everybody. But thank you, John, so much for doing this for us, especially after a long weekend. So I thank you all for being on this wonderful call. Thanks, John. Thanks, everyone.
Absolutely. Good speaking with y'all. Y'all take care.
Bye.
Thanks.